Good morning, everyone, and welcome to our first Global Investing webinar. I am Shreya Roy, and I am joined today with Bastian Teichhuber, our CIO, Henk Kotze, Head of Cash and Income, Rupert Hare, Head of Multi-Asset, and Siso Matanyane, Head of Equities. Welcome, gentlemen. Thank you to all the viewers for joining today. Please feel free to engage throughout our session, and we'll do our best to address your questions in the Q&A afterwards. Let's get right into it. Basti, given that the theme today is global, can you please give us an overview of Prescient's global offerings and tie in the overarching systematic investment philosophy?
Sure, Shreya, thanks. And also thanks from our side, everyone, for dialing in. So good opportunity to set the scene right at the beginning by showcasing our product range. So we're going to speak about 3 funds today. The first being our Global Income Provider strategy. Global Income Provider, obviously run by Henk and his team, a very systematic asset allocation focused income fund. Very proud, basically the foundation of what we do in the global space because it just works. And we've got more than 10 years of track record being actually in the first percentile of the Morningstar category, so right at the top, so to say. And we're going to then dial in from there into our core global equity strategy, which is run by Siso and his team, which uses the same alpha engine. So basically, we're producing the same fixed income alpha as Henk would produce with his team, but we're putting that on top of clean equity beta. So you're getting the steadiness of the fixed income alpha, but the reliability or the long-term risk premium of the equity beta, and that works pretty well as well. We've got a track record more than 10 years beating the MSCI World, which is something we're quite proud of. And then last but not least, we're going to speak about our Global Balance Fund, which is run by Rupert and his team, and that's basically where everything comes together. So everything smart from the fixed income side, via everything innovative on the equity side, and then blend that with a quite good asset allocation process. And that's how we create a global offering, which I think is really compelling.
Thanks, Basti. So before we dive into those details, let's take a step back and set the scene globally. We're going into 2025. Which parts of the market are looking particularly attractive and unattractive?
Yeah, it will be easier to speak about the unattractive areas right now, but to start, top down, the world looks actually not too unattractive. We got decent economic growth. Inflation is quite contained. At least we think that it keeps on being on its downward trajectory. Financial conditions are rather tight because of high interest rates, but we think there's more to financial conditions, also tight credit spreads, etc., which are often supportive. Sentiment is swinging more into the positive, so not too much to worry about if I would only look at these factors, but what we do is we look broader, and the key issue, and this is a global theme, is obviously the very stretched valuations. So starting in the US market, we are close to all-time highs when it comes to PE ratios, price-to-book ratios, etc. It's just very stretched valuations. Sentiment swinging to the positive, yes, but if you see how stretched valuations are, that's actually holding that asset class down, where we are now just at a moderate underweight, leading into emerging market equities, and that's where we see a little bit more value, mostly driven by cheaper valuations and easier monetary policy. Neutral picture, but also not overly optimistic. And then if we look into the European equity market, again a negative outlook, because we have not too attractive valuations, and we've got a lot of issues around sentiment and a quite weak economy. So all the global equity markets don't look great. Do we like the bond markets then? The answer is no. We're also not too bullish on those. So if we look into US Treasuries, we've got an inverted yield curve, which is holding us back in terms of seeing value on that curve. And I mentioned the quite decent US economy, which means there's a lack of demand for haven assets. So with that, US bonds also moderate underweight. Maybe the credit space, not even. Spreads are too tight, so we see these as expensive as well. So very little places to hide. So the global landscape is expensive throughout. There's one area which we do like, and that is actually the very front end of the US yield curve, where you get very high interest rates with very little risk. That's where income provider strategy can play. It can play throughout the entire curve, but right now that's where we're positioned. And we do think that you're getting quite attractive inflation beating returns there.
Thanks, that was quite comprehensive. So let's look at what people are talking about, because in many conversations, in the news headlines, there's one name that's on everyone's lips, and it's no surprise that that is Mr. Trump. So let's address the elephant in the room. Given that President Trump is now in power, are global markets not more risky to invest in now than they were before?
I'll speak about the risk and the uncertainty just now, just starting off with Trump. So with that, we'd like to eliminate the headlines and not just focus on those, because the headlines always, especially when we speak about Trump, they like to pinpoint the negatives, which is fair. And not everybody has to like him, but I do think that if you look at market pricing and you just back out clean what markets are telling us about the perception of the economic policies which Trump is implementing, you actually get more positives than negatives. Starting, for example, by looking into just valuation metrics on the bond side, we can see that inflation expectations have remained anchored. So the story that the tariffs will spark inflation are not really bought into by markets. Long-term interest rate expectations haven't really risen. If we look into an inflation risk premium, so is there more uncertainty around inflation, that also hasn't moved. So backing out of the US bond market, we can't see anything negative about Trump taking office yet. And we can then look into more surveyed data, so basically look into consumer confidence, business confidence. Both of these indicators are on the rise. So again, highlighting optimism when it comes to Trump's economic policies. And then last but not least, what we also do at Prescient is we back out market implied volatility to see how much uncertainty is priced. And if we do that, we can look into equity volatility, currency volatility, commodity volatility, fixed income volatility, any volatility you want to. And all these markets actually pinpoint to hint towards a quite complacent environment, which is not necessarily positive, just means that markets are really not concerned about Trump. So whichever way you change it or turn it, markets are quite complacent when it comes to that. So on your question then, is the world more uncertain than it has been in the past? I think it always feels more uncertain than the past because we have this inherent cognitive bias that we're just more attuned to the more recent history, and we more like it always feels uncomfortable to look into the near-term future and always feels more risky than the year before. But if we are realistic and we look into the last 20 years, we had a great financial crisis, we had a virus, we had a lot of wars and geopolitical risks materializing. So I'm not sure if the world is more uncertain now than it has been in the past. Actually, nothing hints that it would be.
Well, I think it's good that we know that it's not all doom and gloom, and I think that's quite positive. So now it's time to dig a bit deeper into more asset class specifics. So we'll start with the more conservative side of the risk spectrum. So we'll start with you, Henk. And what we'd like to talk about today is global income provider. So there have been some improvements in that space. There's been some refinements to the process. So would you mind taking us through first how you manage the fund and how you've fine-tuned the process?
Excellent. Thanks, Shreya, and thanks everyone for listening to us. Absolutely. So, Bastian gave us a very good platform to expand on the product offering that we run. And specifically focusing on the income fund, the very front end where we do see quite a lot of opportunity. We have enhanced the process. So it's not a complete revamp, but taking what we know as Prescient, being systematic, using our skills and asset allocation, finding opportunities in the global space within that. We've enhanced the process to a process now that we're very, very proud of, and certainly one that clients have found very interesting and found a lot of value in. So if you look at the following asset class list that we've compiled, so from being previously focused on SA names specifically, the market has evolved to a place where it's giving us opportunity to gain asset class exposures globally very efficiently, very cheaply, via different structures such as ETFs. And what you can see here, what we've done is to identify a number of different asset classes. So if we go into the asset universe, you can see almost 15,000 different instruments represented by about 23 different asset classes. So I'm not going to go through all of them, but basically we have the South African dollar yield curve. We've got the US yield curve here. We've got some short duration interesting instruments. We've got liquid high yield, liquid investment grade, short duration investment grade, corporate bonds, emerging markets, etc., the European sovereigns. So a very diverse but also comprehensive list of opportunities that we can take advantage of in the new enhanced process to make sure that when building a portfolio in the global income space, it's representative of one being global, but also it hits the return targets that we set ourselves within the the appropriate risk framework. The next step then, what we do is we throw all the instruments or opportunities into a two-dimensional frontier. So looking at the risk versus the return, or what we expect to return, and we do an efficient frontier of portfolios that would be optimal from a return perspective, given the amount of risk you're taking. Okay, so now that we've created the universe, we've gone a step further to see what would be optimal from a risk and return perspective, and then the next step is where the Prescient DNA would come through on what we expect to return. So our return expectations on the 3-year side, so trying to beat US CPI, and then most importantly our capital preservation target. And this is, again, as I said, where the DNA of the product and global income provider has never changed and won't change. We'll run the portfolios using these criteria or these metrics, and from there we'll pick a portfolio that's most optimal, given the capital preservation of not losing money over any 1-year period, and then also on the return side, be outperforming US CPI plus 1.5. Yeah, so as a sort of a refresher, what I've shown you is the enhanced process. The opportunity set being a lot more global, our ability as a South African manager to compete in the global space using our systematic process really gives us that edge. We don't have to have credit analysts across the globe making decisions around trying to invest in Credit Suisse relative to BNP Paribas. We have asset class views, so we can have a view on global bank credit spreads, and with our view creation, we can be optimal in the way we asset allocate across the yield curve globally, and use those tools in our process to build a portfolio that we see as optimal from a return and risk perspective within the global income space.
Great, thanks Henk. So some very exciting changes that have come through there. So if we shift our attention now to interest rates, because interest rates are quite important for fixed income assets, right? So what's changed with regards to market expectations, and how does this impact the Global Income Fund?
So I think the key change is that the expectation for rates to be lower in the near future is not there anymore, right? So more elevated yields in the front end of the yield curve is the key change that we've seen. And as Basti started with, that's great news for us. We get to earn those yields. Why is that? Why has the rates moved higher? Well, as Bastian also touched on, we see US growth as stronger than potentially what markets would have expected. The Fed pricing for the end of this year, from pricing in September last year, 10 cuts to the end of this year, to now only 1.7 cuts left after we've seen 4. So certainly a lot shallower cutting cycle. Just means that we have a lot more interest to earn in the fund specifically. So what we have seen is not really a lot of opportunity in the longer end, so not a lot of duration in the portfolio, a lot of front-end heavy lifting that we do, but still very attractive real yields. So a dollar yield of around 5.5, some solid performance throughout last year, really hitting our benchmark within that risk framework, right? So we don't have to take a lot of risk to get where we want to be on the US CPI side. So great enhancements, markets kind of moving in our direction, and still lots of opportunity.
So lots to look forward to there. Very exciting. Now, if we talk about the positioning of the Global Income Fund, what are the opportunities that you're seeing there, and what can you sort of take advantage of?
Yeah, so credit spreads being fairly tight. Our credit positioning is fairly light. Very front end being elevated, a lot of opportunity in that space. But if we look at the current asset allocation, we can see that quite a lot of exposure to 3-month US deposits, so 30% of the portfolio, 40% of the portfolio in floating rate bonds, so no duration taken there, but generally high yield, high quality credit names in that space. Interesting allocation to front-end South African dollar yield, so what we would call the SOAF 1 here, attractive for us, and then liquid high yield, small slither, about 7% of the portfolio, and almost more interestingly, a little piece of US-backed mortgage securities, which really represents opportunity to reduce your credit risk because it's got mortgage-backed securities, a very, very highly rated opportunity in that space. So as I said, fairly light on the credit exposure, very heavy on the front end. You can see from a running fund yield around 5.5%, that's a dollar yield, duration of half a year, certainly getting to our return target with not having to take on too much risk.
So elevated yields, not too much risk, it's a great time to be in income. So we've been talking about interest rates quite a lot, but it's not just important for our fixed income assets, it's also important for our equities. So let's move a little bit up the risk spectrum and turn our attention to seesaw. So seesaw, let's also take a step back here. And how do you see the global equity market progressing? What key themes have you picked up?
Yeah, okay, that's a good place to start. And thanks, Shreya, and thanks for the viewers for taking the time to listen to us. When we think about the global equity markets and the themes sort of driving it for 2025, I think quite a bit has been covered already. We mentioned Mr. Trump and essentially how, if you listen to market commentators, it's all about his US first policies and the impact that will have on global trade dynamics. And we're hearing a lot about tariffs and how those will likely feed into the prices of everyday goods, inflation, and eventually whether that will impact the monetary policy environment or stance at the moment. But I think if we think about the themes that are more likely to drive the markets, you cannot not speak about AI. So it's been a theme that has been driving markets over the last year, and one that will likely continue to do so going into the forward periods. So AI has been this massive disruptor and has this ability to unlock efficiencies which will lead to economic growth. Think of economic growth as a function of labor and capital, AI being a technological advancement that allows output to be increased with the same amount of labor and capital inputs is a big game changer. The initial reaction has been sort of to the primary enablers, but I think going forward again it will be more of a secondary type market where we're looking at beneficiaries of some sectors will be beneficiaries of the AI efficiencies, and other sectors will most probably be the benefactors, and those are the ones you want to stay away from. So that is likely to be a big theme. Lots of disruption, lots of volatility, markets sort of at a bit of an inflection point, and I think what that highlights is the importance for a solid, robust, and risk-managed investment process to help you navigate through these market conditions.
Absolutely agree. Let's talk about AI a little bit more. So you mentioned that it was quite a big theme last year as well. And if we look at the Magnificent Seven performance, I mean, it's been incredible. But the problem now is that the market is more concentrated than it was previously. So how do you think about diversification? How do you diversify in equities?
Yeah, that's a brilliant point that you bring up, and in fact, I think last year in one of our Prescient On Point publications, we actually put out a bit of a cautionary piece around diversification or thinking about diversification and going offshore. So diversification is a great risk mitigator, particularly idiosyncratic risk. But in order for diversification to work, it really relies on correlations, the extent to which share prices move together. And what we found is that the correlations generally tend to spike when when the markets are quite extreme. So you look at the S&P 500 over the last 2 years has given sort of 20, 25 plus returns. It's quite an extreme up move, and therefore correlations tend to be quite high. Or you find it difficult to make diversification work where markets are concentrated, as you said. And what we try and accomplish with in addition to that is, say, if I'm an SA investor thinking of taking money offshore for the benefits of diversification, having access to over 2,500 shares, etc., is it still viable, given this concentration, to simply just say, listen, I'm going to buy the S&P 500, when if you take out the Magnificent Seven, the other 493 shares are essentially flat, and all of the return is being driven by these 7 shares, which are all of this similar theme. So in our portfolio construction, we diversify essentially across asset classes as Basti sort of alluded to in the beginning. On top of getting access to a wide breadth of beta or securities in the equity space, we also get this uncorrelated source of alpha from the cash and income space, which gives us an additional breadth or exposure to an uncorrelated asset class. So truly diversified beyond simply just 2,500 names, even though 493 of those are basically irrelevant and only 7 are tracking the actual market.
So you diversify across asset classes, but you and your team manage an equity fund. So this essentially means that you're giving our clients more than just an ordinary equity fund. And you've touched on why this is beneficial, but can you walk us through the implementation?
Yes, I'd be happy to do so. And I think that's one of the innovative side of this portable alpha process, in that there's many ways to implement portable alpha. Basically, maintaining or separating the sources of return between asset classes or different processes, and we simply just elect to do it via the cash and income space. So if you think about the exposure that our clients actually receive, the bulk of the return is driven by the equity market. Just the relative performance to the equity market is derived out of the fixed income space. Okay, so if we look at the exposures that our clients get, they basically get this passive equity market beta exposure, and this is where we would target something like an MSCI Developed Market Index or MSCI Emerging Market Index with exposure to thousands and thousands of shares. We would do that in an unfunded way, meaning that we retain the cash instead of relinquishing the cash to buy the individual securities. So either through a future or total return swap, where we're basically just trading on the margin. And then the bulk of the cash is then in this piece here, which is an actively managed cash and income portfolio. And within this cash and income portfolio, we obviously then try and generate as much return as possible, which is directly transported on top of that equity market beta to give this return profile of equity market return plus fixed income alpha. Yeah, so the reason we prefer this approach, there's multiple, but I think I could summarize it in saying, obviously, investors get the full equity exposure, clean, efficient beta, without the value destructiveness of stock picking. So we spoke about valuations being really, really high earlier, for instance, if you look at the US, and if you're just investing in the equity market based on valuations, you would have probably missed out on the rally of the Magnificent Seven. So with our approach, you get the clean beta. Whether the market goes up, whether the market goes down, you get that pure beta exposure. And then on top, you get the fixed income, uncorrelated fixed income exposure, which is a much more reliable source, particularly when we're talking about relative performance, given the contractual nature of the cash flows that are in the fixed income space versus the equity market. And it's a much more easier space to generate outperformance than the equity market is. So you get that fixed income profile on top of the equity market beta. And then we like this approach because it's then truly diversified. Your sources of return are clearly delineated and each are driven by their own factors. And then finally, we like this approach because it's a very efficient way of allocating capital. So instead of just being pure passive in the sense that you just buy an S&P 500 ETF, for instance, and tie up your capital, we are actually putting the capital to use where it will get the most benefit. It's just that happens to be in a completely different but better behaved asset class. And because we're not, fundamentally analyzing each of the 2,000 shares over the world, it's very cost effective. The futures or stock market in the offshore space is much deeper than the cash equity space, the trading costs are much lower, and any benefit we get from the actual implementation is passed on directly to the client, and you can see that in sort of the costs or the costing of our product offering.
Thanks, Cecil. So it seems like this portable alpha process has been really thought through, and Prescient's been doing it for many years. So there's lots of experts behind it who know what's going on. Talking about interest rates a little bit more now, we spoke towards the fact that we could potentially have higher rates for longer. Now, for a process like portable alpha, which is closely linked to interest rates, what does that mean for the strategy? And are there certain risks or opportunities that we should be aware of?
Yeah, that's a good question. And I suppose one of the more confusing points about our equity proposition is that often to talk about our relative performance capabilities, opportunities, and risks, we have to stray into this cash and fixed income space. But again, being that we have the expertise of the global income provider investment process, the alpha engine is exactly the same. So what Henk was mentioning, for instance, about value in the very short end, given that the term structure is so flat for interest rates, we would be positioned exactly the same way. Credit spreads being tight as another lever we can use to gain exposure. We're quite cautious on credit assets at the moment. So from a positioning perspective and opportunities and risks, very similar to our global income provider process. I think that additional nuances with our process is, of course, that we have this funding cost element on the back of our synthetic beta or unfunded beta, where we have to manage that quite closely. The biggest risk, of course, is that we see a spike in funding costs, which narrows the pickup or the carry that we're able to deliver. But there's opportunities everywhere, and the great thing is that the global space is much more, the global regulations are much more conducive to this type of strategy, as opposed to, for example, locally. I think we have more reign, and we're better able to express our investment view in the UCITS environment than we otherwise would be in the local market, for instance.
Thanks, Cecil. So, it's great that we're able to actually increase our opportunity set, and that's great for many reasons that you mentioned. Yeah. So, we've talked about fixed income, global fixed income. We've talked about global equity. Now it's time for Rupert to take center stage and talk a little bit more about multi-assets. So when we think about constructing portfolios, where do we start?
Thanks very much, Shreya, and thanks to the three for the intro into multi-asset, because I think it's important to just highlight that my role is essentially in sitting between these two. Bastian, probably very similar as CIO, in that I have to now combine equities and fixed income globally. And the question that we often get is, okay, you're sitting in SA, where do you even start? How do you know global markets to the extent that you can allocate into different geographies, different asset classes, and so it goes on, different currencies as well. And I think that the answer was actually already provided by the previous two in Henk and Cecil, in that we also focus on first and foremost asset allocation, but back that using portable alpha strategies. So the most important part for us is that we can deliver alpha through portable alpha on top of the underlying asset classes that we get exposure to. So we've got the same process, but the additional cog in the wheel for us is to try and optimize the mix of the base assets. So how much equities, how much bonds within the portfolio. And that is done to try and maximize the likelihood of a client getting CPI plus 5, so a longer term type investor in a high equity type product. So if we focus on the strategic asset allocation of the global balanced fund, it will look somewhat simplistic. We start at the top right here with developed market equity exposure. That's 40%, that's towards MSCI World Equity Underlies. That means we've got 1,700 roughly names within that bucket. The second slice being here, emerging market equities, again just shy of 2,000 names within that bucket. Developed market bonds, we can play the curve across multiple developed markets, primarily focused in the United States as a diversifier in the event of sell-offs. And then the last one here is 5% towards developed market income. Now, you might think that I'm neglecting Henk and team with only a 5% allocation, but it's actually far from it, because the whole fund is backed by the cover asset process. So our developed market equities, emerging market equities, developed market bonds, all leverage off the same example that Cecil was talking about, where we get a slight pickup over funding costs and deliver you the base asset classes, and then on top of that, we also give you that portable alpha profile. Okay, so we've got our structural allocation within the fund towards the different asset classes. The other tool that we take advantage of is tactical tilts. So we have these asset class models, which are models around the world, around different asset classes, and there are growing by the day, but now approaching 100 different asset classes at a sub-asset class level, that we can take asset class views on from the comfort of Cape Town. So I think that is one of the key differentiators as a multi-asset manager sitting in South Africa running multi-asset global portfolios in a very efficient way, using equity exposures backed by fixed income alpha on top of fixed income exposures, which give us that consistent profile that Prescient's so well known for, and we're able to do that within a multi-asset offering.
This multi-asset really is at the center of all the other asset classes then, so where would we be without you two? So given that we look at so many different parts of the world, are there any markets that we don't particularly tap into? And can you maybe comment on where we're going in the future with regards to research in these areas?
I think that's the most exciting part of how we think as investment managers. So naturally, we don't have underlying models on every single country in the world, but we have infrastructure that's been developed such that we've got models on global equities, including the US, Europe, etc., emerging markets. And from here, we can just take it steps further, iteratively further, and go deeper and deeper and deeper, because the models are built in exactly the same way. So we're quite comfortable as we are playing global macro allocations towards developed market equities, emerging market equities. And down the line in the future, we would look towards potentially taking a tilt overweight into the United States and less so into Europe. So it's all about model development, but using the same framework and continuing the same investment process.
So we've talked a lot about global today, and we sit here in our Cape Town offices, as you mentioned earlier. Do you think it's viable for a South African manager to manage offshore investments from here?
I think it is. I think you just have to pick the right South African manager. So you have to take a step back and think, what do you need to run global investments? How does your philosophy work in terms of global investments? Now think of a single stock picker, for example, a South African-based single stock picker who does deep dive fundamental research in South Africa. It's fantastic, but how would you do that when you expand your universe into that 2,000 plus securities in the large cap space alone? You can go beyond that into the mid cap, small cap space as well. So I think you have to rethink how you run your assets. You have to think along the lines of using systematic data-driven insights to take views on asset classes all around the world, instead of flying to do due diligence in whichever country it might be with CEOs or other board members. It's just not viable at the fee load that we charge within our funds.
And at the same time, we get to enjoy a beautiful Cape Town summer. So thanks, Rupert, for your very insightful comments around the multi-asset space and how we really tie in the other investment teams on the floor. Let's go back 1 month ago. There was an article on CityWire that talked towards 10 funds that missed their benchmarks by the most in 2024. Now, all of those funds were global funds. Basti, what is our view on that? And what approach do we take to global investing? And then just to follow up on that, why would clients choose Prescient as their global partner? Because there's, of course, a lot of offshore managers that are offering similar solutions.
Yeah, sure. So I think it shouldn't be too much of a surprise that the 10 biggest underperforming funds are all global funds, because the global investment universe is vast and full of challenges. Often markets are way more efficient here, and they offer much more room for mistakes, much more room for errors. So you need to know what you're doing if you operate in that space. So with that, no surprise that many South African managers get it wrong in the global space. will go as far as saying, of course, South African managers are not able to compete in the global space, and none of that changes by having an office in London or New York with 5 or 10 analysts. That won't change a thing because markets globally are too efficient. But I do want to change perspective, not just highlighting what doesn't work, also highlighting what does work. And I do think that the difference between a working investment approach globally and an investment approach which is not working globally should be less linked to the geography or geographic location of the headquarters of the company. So whether you sit in South Africa, in London or New York, I don't think that affects too much whether you succeed in global markets, and the evidence for that is clear. You can see in global markets 90% of the active stock pickers also can't beat their benchmarks. Most of the global managers charge too high fees and they all underperform as well. So it's less a story about South African managers being able to outperform global markets and global managers maybe being better or weaker. It's more about which investment philosophy actually works. And that links in with what Rupert says. So we have an alternative approach. We don't stock pick, what we follow enhanced indexation approach. Kind of every year a little bit of positive alpha on that. We focus on asset allocation. We apply a systematic strategy with way lower costs. We don't charge high fees. So you combine all of this stuff, which actually works and drives outperformance. And with that, we want you to think Prescient Local equals Prescient Global. So it's the same philosophy, it's the same people, it's the same processes, it's the same expertise if you want to, and with that it's the same consistency in performance. And that's why we have no shy to say that. Look at our global funds. We rank very, very high in the income space, very well in the balance space, and in the equity space we've beaten the MSCI World for 10 years straight. So it works, but you have to have the right approach.
It's a great track record. So we've got the right offerings, we've got the right strategies, and the environment looks quite attractive for our strategies. So what could go wrong?
I guess a lot of things can always go wrong. We mentioned in the intro already that valuation is quite stretched, and that's probably the key risk. So we're less worried about the global economy rolling over. We're not worried about financial conditions tipping the world into a financial crisis. We're not worried about sentiment being either too positive or negative. All of these factors play important roles, but we see those as actually mostly quite positive. What does worry us most is in the global space very stretched valuations, which means everything is priced to perfection. Not a lot has to go wrong for things to fall quite a bit, just because we're coming off so high levels, and that's on multiple metrics. So that's the core risk. We spoke about Trump earlier. Obviously a lot of risks are linked to him, not just in the negative space, but we also think a lot of risks lie in the fact that he might not deliver on the positive space. What if he can't deregulate? What if he doesn't cut taxes? What if he doesn't achieve to create a rise in productivity? So there is a lot of risks out there. Luckily, we do want to say at Prescient, risk management is always at the heart of what we do. So we've got the right tools, we've got the right strategies, as we've seen today. And with that, we feel very well equipped to navigate those challenges.
Thanks, Basti. That was very well said. Thank you, gentlemen, for your time today. That's unfortunately all the time that we've got. But thank you to our viewers as well. And please don't forget to ask us any questions that we'll answer in the live Q&A that will follow soon. What we can leave you with today is that our systematic investment philosophy really does have risk management at the heart of its process. We've got a range of global investment funds that are tailored to very diverse objectives and risk appetites. So whether you're pursuing stable income or longer term growth, we've got a solution for you. And our portfolios are designed meticulously to optimize returns whilst also catering for the risk environment. So join us on our journey to gain a competitive advantage in the global space and strive to meet your financial objectives with certainty.
Good morning, everyone. Thank you so much for sending through your questions. We'll jump right into them and get to as many as we can. So the first question is, you mentioned that global equities are unattractive, yet over the last couple of years, they kept on going up. What went wrong in your assessment? Basti, maybe a question for you.
I'll take that one. Thank you, Shreya, and thanks once again, everyone. A couple of good questions. I will try to tackle as many as possible. So why did equities continue to go up? Why we thought them as expensive? Well, first of all, I want to say that we've not been constantly underweighting in them. We've been like a bit in and out into that asset class. So we participated in a big portion of the trade. Also strategically, we've got a lot of global equity. So last year was actually an amazing year for us. It is just a temporarily at times underweighted it because of the expensive valuations. But I guess, speaking to our process, it's not just about valuations. If we would really just look at valuations, we would have been underweight in US equities over the last couple of years. That's true. But for us, it's more about the interaction of valuations with other assessment tools, like we also look at economics, financial conditions, market sentiment, and it's for us more crucial how these factors interact with each other and how they interact with inflation. That basically defines our positioning. So with that, yes, we continue to see the headwinds of tight valuations, but doesn't mean that we have to always be negative on that asset class, but obviously the hurdle becomes ever bigger at these levels.
Thanks, Basti. And then the second one is, you mentioned that interest rates are still high and that the front end of the US and the SA curves look attractive, and that the environment is therefore well suited for income strategies. Does this still apply after the recent rate cuts?
Yes, it definitely still applies because the recent rate cuts have been quite shallow, so been priced for a very shallow cutting cycle. I mean, in the States, we have 1% lower rates than we had at the peak. So 3 cuts, one of them a 50 bip cut, taking us to just 4.5 at the top of the range. So pretty much very high. And in South Africa, same story. We actually only had 75 bips lower interest rates than we had at the beginning of the cutting cycle. So still very high rates. And then it's important to bake in the inflation assumptions and also where we see inflation going. So just focusing on South Africa now, our income provider strategy is still earns in excess of 10% with very little risk. So that's obviously very, very attractive, but it becomes more attractive if you link it to inflation. If you look at inflation printed at below 3%, so below the bottom of the target range of the last couple of months. And then even if you look into where markets are priced, so interest rates are not priced for much more cuts in South Africa, so we expect that we can hold that high yield in income provider strategy for quite a while. And at the same point in time, if you look at where inflation is going in South Africa, inflation swaps, the 2-year inflation swap is still at 4%, meaning that probably over the next 2 years, best guess is to have not more than 4% inflation. In the next 5 years, it jumps to 4.4. So over 5 years, we see potentially rates equally high to where they at, and inflation equally low as it is right now. So with that, income funds are just particularly well positioned. And then also think about 2 scenarios. Everything stays as it is. Well, that would be perfect. And we just keep on earning those high rates and you're not doing anything wrong in the income fund. Or let's say interest rates do cut down or cut more and do come down. Well, that would lead us to having to reassess. But at the same point in time, it would mean an immediate boost to income provider strategy. So to the performance of any income strategy. So long story short, there's almost no scenario at the front end of the SA curve which fits in the bad stuff.
Henk, this is a question for you. Credit spreads globally are tight relative to their long-term history. How do you think about this when putting the income or the global income fund together?
That's a great question. Thank you, Shreya, and thanks for asking that question. As a start, the first thing we'll do is we'll have a return expectation for each asset class that we can invest into, right? So let's say a high yield credit is that one, and you have to take your base rate, which as we've argued is quite high currently, and then you add your spread, so your all-in yield is still fairly attractive. But then the second component of that is the risk component, right? So we have to think about how that asset class has behaved through time, and does the current level of return warrant the risk that we're putting into the portfolio? And on that basis, not. So we do think they are tight. We're not taking on a lot of credit exposure in the portfolio, a lot more sort of deposits, bank, investment grade credit, etc. So not too much credit exposure, but then also finally, as we made the point in the webinar, there's a lot of diversification. So in the credit space, if you are able to diversify sufficiently, that's a great risk mitigator. And the asset class we take exposure to would have 100 to almost 1,000 different names underlying. So even if there would be one event underlying, we wouldn't really see it. So yeah, as I said, assess the total level of return we expect relative to the risk. Is it appropriate for the current level? Not. And at some point it might be. But for now, we are fairly conservative on that space, and we'll wait to see what happens.
Thanks, Henk. Now maybe a question for Rupert. What is the rationale for hedging currency risk in multi-asset funds?
That's a good one. So two reasons. The one is structural and the other one is tactical. So structurally, hedging currency in a multi-asset fund, you can reduce volatility and you can access more asset classes globally. So let's just talk around that. We often get the question, okay, but you're hedging out currency exposure. That means you're not participating, for example, if you're a South African investor, in the sell-off in the rand, which can benefit your portfolio. And that is correct, but you're also not participating in the recovery in the rand, which always happens because you have an interest rate differential. What you are doing, though, is you're earning that interest rate differential. So if you could picture the scenario where we always get told a Coke used to cost 5 Rand in the 1990s and now it costs 20 Rand, it actually costs the same thing. It still costs 5 Rand in real terms. That's exactly what you're getting participation in when you do currency hedging. You are earning that differential. The second reason being tactical. We like to separate out our views on asset classes from our views on currencies. Very important. An analyst can take a view which is, let's say, overweight US equities, which intrinsically, if you're a rand-based investor, includes currency exposure. But if you can separate those two things out, and you can say that you're overweight US equities, but you're neutral on currency, that we think is a much more appropriate tool to use. And then to end that off, what we can say is that we are currently bearish or bullish on the rand, and we can put more or less currency exposure in the portfolios.
Thanks, Rupert. How do you keep your fees so low if you trade a lot? Anyone can answer that.
I can take that. It's because obviously our investment approach is highly efficient, it's systematic, which means that it's structured and we get a lot of signals on what to trade, when to trade automatically. We obviously keep on improving our process, but we don't need analysts to speak to CEOs, not adding any value if we don't have to pay those salaries. So for us, it's quite possible to keep the fees low, and the frequency of the trading is really not a problem. Yes, we are able to trade into our strategies daily, but that's not really linked to the costs. It's more linked to the fact that we get so timelessly our signals and that we basically can reposition ourselves very quickly to what we think is optimal. So yeah, it sounds very attractive to have such low fees, and it is, but I mean, it's all part of the game.
Plus, the market we trade in is exceptionally liquid. That means that your trading costs on these instruments are very, very tight, and it's almost not felt on a fund level. So it's one of the benefits of doing things the way we do.
Thanks. Okay, there are increasingly more global players entering the South African market. How do you see this playing out for South African managers?
I'll start with that one. So since the change in rate 28, we've seen this outflow rather, of cash from South Africa and an inflow of offshore asset managers looking to offer their products in South Africa specifically. So we see that for the industry as an instance of adapt to survive. But for ourselves, we see ourselves as already positioned for exactly that sort of offering. We've always run global multi-asset funds, global equity funds, global income funds. We do so, as Bastian mentioned, by leveraging off data science. So all we need to do is to have access to data from all the way around the world. In other words, a good internet connection. And then we can run funds from Cape Town. So I think that's one of the key inputs. And then just going back to the fee question, we think that's going to be additional fee pressure from those offshore managers coming into South Africa. So looking forward, if we wanted to future-proof ourselves for managing money in South Africa in the global sphere, you have to be competitive on fees. And we think we're already competitive, so we're ahead of the game.
Thanks, Rupert. And then the last one, probably a good one to end off on, where are these funds available to invest in?
Yeah, so you can invest directly via Prescient Fund Services Ireland, or you can invest in feeder funds in South Africa. So we've got a feeder fund for all of the funds we talked about today. So either if you're in South Africa looking for a route to offshore, or if the cash is already offshore and you're looking to invest, it's easy to invest into all of our Prescient funds. So I guess it's all about just opening an account.
Thank you. Thank you, gentlemen. And thank you to our viewers. That's all we've got time for. Please reach out to any of our business development managers on the Prescient website if you do have any more follow-up questions. And other than that, have a great day further.